More and more real estate investors are switching things up these days because relying on market appreciation just isn't as predictable anymore. Now, the focus is more so on finding assets with better rent yields or diving into renovation projects for faster, more reliable returns that you can actually control. Plus, with interest rates coming down, borrowing for these types of projects is also getting cheaper, making it an even smarter thing to take on these days. But here's the thing, it's not just about knowing how to build or how to renovate. Financing these projects can actually be a big roadblock for many investors. There's barely any clear information out there, and you end up having to figure it all out on your own. And so in this video, I'm going to try to break it down for you so that you can find out how exactly to finance real estate projects in Canada so you're not left in the dark. But before I do me a quick favor, hit that like button, subscribe for more real estate investing tips, and if you want to chat one-on-one about your Toronto real estate investing plans, feel free to book a call with us. Let's start with a purchase. Most banks will finance up to 80% of the purchase price for an investment property. You might be able to use some of the rental income on the existing property to boost your borrowing power too, but how much you can borrow really depends on your income. For example, to qualify for a $1 million property, you'll need an income of around $200,000 and come up with the other 20% in cash. If you're planning to live in the property, you could go above 80% with an insured mortgage as long as your income supports it. Now, this can be a big help for high-income young professionals who might not have a lot saved up yet. But here's the thing, purchase financing is actually the easy part. For renovations under $300,000, your best bet is usually to finance it with cash or a HELOC if you've got equity in other properties. There's also an option to borrow $80,000 from our Canadian government at a low interest rate of 2% for 15 years if you're building a secondary suite in your own home. But once renovation costs or construction costs goes over $300,000 or more, it's going to be a lot tougher to finance with cash or a HELOC, and you're typically looking at construction financing. And this is where things start to get tricky. Now, banks do offer interest-only construction loans and release funds to you in multiple draws if you're looking for one. You typically need about a third of that total construction loan amount upfront, and then the future draws only start when you hit certain milestones in your construction process. And then on top of that, you need very strong income to qualify for a very big loan. For example, if you want to borrow $2 million in construction money at over 8% interest, then you'll probably need an income of $350,000 or more. So yep, that does leave us with a pretty narrow pool of investors who can actually qualify for this. And here's a couple more things you might not know. You have to use the same lender for construction financing that you used for your purchase mortgage because banks won't want to take second position on your construction loan. And also, if you are thinking about doing a project with 5 to 6 units, remember not all banks will offer construction residential loans for that. Now, if you or a close relative plans to live in the property that you're going to build on, there's also a new insured construction financing option for projects under 5 units that just launched on January 15th of 2025. This program lets you borrow more up to 90% of the completion value, basically because it's insured. However, because it is a new program and it involves mortgage insurance and people are still ironing out the kinks, approval times can be longer for this as well, so keep that in mind. For larger projects with 5 or more existing units, you might be able to use CMHC's MLI Standard or MLI Select programs, but just note that these cannot be used for conversions where you're converting a single family home or something under 5 units to over 5 units. And finally, if these options do not work for you, private financing is always an option, but be prepared for much higher rates. We're looking at 12% or more these days in early 2025, and that is $15,000 just in construction loan monthly payments not including the principal paydown and not including the purchase mortgage. So going this route is actually pretty risky. But once you get through the whole entire project, let's talk about refinancing to pull out some of your initial capital. Since you've probably put in more cash and the property's value has gone up after the project, you might be able to borrow more against the completed value at better rates through a conventional mortgage. Now, for properties with 6 units or less, you can potentially refinance with a residential mortgage for up to 80% of your loan-to-value ratio, your new completion value, based on market comps. But in a more uncertain market, the cash-out refinancing amount can be hard to predict, especially at the beginning of the project. Plus, if you're looking at a multiplex, you might be at the mercy of the appraiser since there are very few comps to go off of at any given time. And then, if you end up having 5 units or more on completion, what you can do is go commercial. Typically, you're looking at programs like CMHC's MLI Select or MLI Standard again, offering you at least 85% loan-to-value ratios and 40 years plus in terms of amortization. The benefit here, refinancing larger properties like this is based on your rental income and cap rates, and so you will have a better idea of how much cash you can pull out on completion even when you're crunching numbers at the start of your project. All right, now you've got the financing roadmap to get you started, but let's also talk about where to invest. Real estate in Toronto, where we are, is more expensive, which does mean the bar is set higher for investors, but that's also exactly the reason why it makes more sense to take on projects here. Construction costs are pretty much the same no matter where you are in Canada, but with Toronto's higher property values, the payoff ends up being much bigger. Renovate or build here, and you're looking at better completion values, more cash out potential, and better returns that you can't actually control. But here's the other thing. Smaller projects are simpler, less risky, faster, and cheaper. And you can still refinance, pull out a good chunk of your capital, and still stay cash flow positive. On the other hand, if you look at big projects, the numbers, absolute numbers, can look great, bigger cash outs, more room to scale, but pulling them off is actually a completely different ballgame. Financing needs to be in place, rates need to line up, and the construction has to stay on track, on time, and on budget. One mistake can turn a solid deal into a major loss. So unless you've got deep pockets, construction know-how, and the time to manage everything, those very big projects that need construction financing probably isn't the right move for most investors. And if you're not sure where to start or what makes the most sense for you, let's chat. We're not just a real estate sales brokerage, we're experienced investors here in Toronto, especially when it comes to multiplexes and value-add projects. Whether you're looking for a turnkey property or you're looking for one that you can convert into multiple units, we've got the expertise to help you figure it all out. Here's how it's like to work with us. We'll take the time to understand your goals, dig into the numbers to find you the best opportunities, and help you find the right property in the end. And if you're planning on taking renovations on, we'll connect you to our trusted contractors and be around as a pseudo coach as you manage your project. Once the work is done, we can handle leasing and property management for you too. And if you're ready to get started, just head over to this link here and let's chat.